Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. The most recent activity seen here was firstly the development of a July to September bear channel. Now this calmed the market down after its heavy fall in late June, yet still gave it a bearish tinge. Then in late August the market broke up above the upper bear channel line. Initially this break higher looked like it would be capped by the descending short medium moving average, currently 841. And this moving average did do that. But after a week and a half of testing, the market broke up through this moving average, thus legitimizing it as a definitive break higher from the bear channel. Prices next rose through a fairly free zone up to the next series of resistances. These were the 50% Fibonacci lines of the December 2017 March 2022 move at 887 and a May 2019 to March 22 move at 891. These two only lasted a week before being in turn broken and seemingly converted into supports. The next obstacle was the congestion around the 50% Fibonacci line, the September 2019 to March 2022 move at 908, which was broken above late last week. The market went on to tackle some much more serious pieces of resistance. These were the combination of slowly descending medium moving average, currently 907, and the important slowly rising long moving average, currently 935, the latter at times coinciding with the November 2012 high at 930. I initially favoured the slowly descending medium moving average as it capped earlier attempts higher, in part because it is a declining moving average and not a flatlining one or slowly rising one like the long moving average. Both these two moving averages and the November 2021 high initially looked as if they had been taken out as resistances and converted into supports, but this week prices have moved back down as far as testing the 50% Fibonacci line at 891 and 887. In this process, over the last 2 weeks, we have seen prices tackle both the upper trend line, currently at 969, and the lower trend line, currently 918, of the mid-August to date ascending wedge pattern, breaching it, but as yet not breaking it, twice on the top side and most recently on the downside. The question here, as it was last week and the week before, is whether these breaches are the real thing. Indeed, which breach is the real breach and not a false break in either direction. The market's rise up into this congestion area between 887 to 935 seems to have triggered this activity and possible outcome as well. Thus, it is too early to say it is a break of the ascending wedge pattern, but it may be happening soon. Now, 3 final points. Firstly, the next significant congestion above is in the band 972 to 981, based around the 50% Fibonacci line for the March 21 to March 22 move at 978. I do acknowledge the August 2008 high at 960, but I'm still not convinced as to its efficacy as this single piece of congestion. Secondly, as I've said these past 2 weeks, I saw the possibility for the whole of the July to date action being a V bottom. On this now, I am convinced the only outstanding issue is whether the V bottom will have an extension, such as a bull one or a bull flag of some form. Now, so far it doesn't seem to look that way, but it is worth looking out for. Finally, 2 weeks ago we had a weekly key reversal up. I had mentioned this before, and now it added further support to the bullish incentive at the same time. Well, whilst there have been an overall move higher, this break below the lower trend line of the ascending wedge pattern has offset this somewhat. So I think a question mark over it as a support for the bullish incentive needs to be added. Chicago corn. I'd like to recap once again some key elements of my comments over the last few weeks, as they still seem very valid. The first factor is the reverse head and shoulders pattern over July and early August. I was initially unhappy about this pattern, but it has turned out to be a good one, and especially the neckline currently at 680. And that's been incredibly supportive since the market broke higher over it 6 weeks ago, including today. The primary target for this reverse head and shoulders pattern has already been achieved, and we still have the secondary harder to reach target X1 available in the 714 area. Secondly is the impact of the slowly rising long moving average, currently 683. This had earlier tried to cap the market, but as it separated from the 50% Fibonacci line of September 2021 to April 22 move at 661, its efficacy as resistance faded, with the market moving through it, and has recently become partially an indicator of the very recent bearish angle of attack, and partially also as support. Finally, and most important of all, there is the July to date ascending wedge pattern, currently at 809 to 725. Now, I have personally found this to be the most elegant of all the factors I'd spoken about. After going through a fragmentary phase with a little too much emphasis being made on the upper trend line, looking at where we are now, well, the market is increasingly being squished in between the overhead congestion between 694 and 700, containing the neckline of the old March to June head and shoulders top, currently at 697, and the support of the long moving average, the neckline also the reverse head and shoulders below, and importantly the lowest trend line of the ascending wedge pattern. This situation, I suspect, is coming to a cusp, as the rising support of the lower trend line meets the resistance at the end of next week, or this coming week, and the rising neckline or reverse head and shoulders meets the resistance by the last full week of October. For the moment, I've retired target X1 in the 714 area, a potential target for the upside from a break lower over the ascending wedge pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Tofpik and ADM Investor Services International Limited. And here comes the final bit.